I want to talk a little bit about rates, real estate, and recession. First thing I want to tell you is that while there are some concerns out there about the drop in volume, do you know that 2022 is the third best year in the last 16 years as far as volume goes? And I know a lot of people have gotten accustomed to the great volume levels we've seen in the past 2 years, but this would be according to the MBA's estimate, the third best year. Now, a lot of it's in the purchase arena, so we definitely have to make that decision for success on the purchase side to help us. And the purchase volume is amongst the best that we've seen in the past decade or more. So purchase volume's out there. We just have to get it. I know that there's some margin compression. It's difficult to get par pricing out there. Par pricing for the customer is obviously something where an investor is paying. So if your customer is getting a rate of, let's call it zero, a price of zero with a rate in the upper fives, an investor is paying. They're spending a lot more than that. Otherwise, how would you get compensated as an originator? How does your company get compensated? So, on a $500,000 mortgage, a lender's paying, let's say, $515,000. So how do they get that money back? They get that money back through the increase in interest rate over time. But when this becomes more difficult, like you're seeing today, in some way, that what that's telling you is that, hey, there's good news in the not too distant future. What they're saying is that the only way that they can make money on that loan is if that loan sticks around for a while. So since they don't think that loan is going to have a long life, they feel that that loan will be refinanced in the not too distant future. They want to make it discouraging and painful for somebody to get a loan as a customer with 0 points. And in addition to that, they want to make the differential to get 0 points much more expensive so they can accelerate the benefit they get in interest to offset the amount that they have to pay so that a customer gets a loan at zero. Now, inflation's been the big story. Inflation's what's causing interest rates to rise. What's inflation? It's too many dollars chasing too few products. You might recall when I spoke to you in August, I told you that higher rates were coming, and I explained to you that inflation was on the rise, and that had me concerned that we would see inflation. We told you last August when I was with you live that we saw a recession coming at the end of 2022, early 2023. And guess what? Now almost everybody else is seeing it. So what does the Fed do? The Fed has to fight inflation by making it more expensive to borrow money, not on mortgages. The Fed doesn't affect mortgage rates. The Fed is pushing up shorter term rates like credit cards, personal loans, car loans. So it's more expensive to buy those, so therefore people buy less. They're also increasing savings rates by doing this when the Fed hikes rates, so people now have an incentive to put money away. You think a lot of people that are a little bit older, that have some assets, that haven't been able to put money in the bank to get any kind of safe rate of return. Well, now, if the Fed continues to raise rates, that'll draw money out of the economy and people will tuck it away. Inflation's too many dollars chasing too few products, which tells us that what you're seeing in inflation, how the Fed fights it, is to try and remove dollars from the system. But when the Fed does this, we get recessions like we've been talking about. Now, if we take a look at inflation, the way that you measure inflation is you look at the last 12 months. So if you take a look at April of 2021 and you go every month and you add it all together, you will get the current rate of inflation, which is about 8.5%. Now, when the number comes in this Wednesday for April of 2022 to replace this number, then if that number is higher in April of 2022 than the 0.6 of April in 2021, the year-over-year inflation goes up. If it's lower than this number, then the year-over-year inflation goes down. It'll probably be around this level or higher. But then as you can see, May and June were pretty high numbers. That's why a lot of people are saying that after this report, they see inflation peaking, which means good news for interest rates. I unfortunately disagree, because if you take a look at this, they're not looking at this here. Look at these low numbers here that were in 2021 in the summer. So in 2022, these numbers will probably come in higher. If they come in higher, you will get higher levels of inflation. And we think they peak in October or November of 2022. So that tells us there's about 5 months more of hotter inflation, but then it should really start to simmer down for a lot of reasons. One, the comparisons are high here, and therefore, when the new numbers come in, they should start to soften, especially by then, since the Fed already has hiked twice. They're going to hike another 50 basis points in June and in July, and maybe another 50 or at least 25 in September. That by then should start to take hold. The economy should slow down. People should have an incentive to invest. So that's one of the things that we're looking at, is saying, hey, you're going to get higher comparisons. You're going to get Fed slowing things down. By then, it should start to take hold. And there's another thing too, is that the supply should ease up. The supply chain should get better. And right now, a big problem is in Shanghai. With COVID and their no COVID policy, the largest city in the world, which is the biggest port city in the world also, has 26 million people. And this, it's not an abstract painting. This is a view of the port city of Shanghai. And all these little things you see here, these are container ships. You ever see these gigantic ships that are out there with goods? Well, they're either trying to get in or out. But right now, because there's a shutdown, they're just waiting. Thousands of ships. So hopefully by October, we believe that this mess should get sorted out. So there should be more goods available, which means the price premiums should be more relaxed. Easier to get goods, lower prices on goods, less money in the system, plus higher comparisons. All those three tell us that we should start to see an improvement in interest rates, because inflation will come down. And the Fed's done this before. Under Arthur Burns, when he saw inflation go way up, mortgage rates went way up. But Paul Volcker came in, he started hiking the Fed funds rate. He hiked the Fed funds rate in 6 months from 11% to 20%. That killed inflation. And as a result, mortgage rates came way down. But the stock market didn't like it, and you had a recession. Same thing with Alan Greenspan. He saw inflation go up, so mortgage rates went up. He started very quickly hiking the Fed funds rate. That slowed inflation, and mortgage rates came way down. But the stock market didn't like it, and we had a recession. And now Jerome Powell's faced with a similar circumstance. Inflation's up, mortgage rates up. He might raise rates close to 3% this year from where they were at 0. He's already taking them up from 0 to 0.75%. But we know that there's another 1% coming in the next 2 months. That's 1 3/4. Maybe in September, he brings it to 2 1/4. By the end of the year, it could be close to 3%. If he does that, inflation should drop, and mortgage rates should decline as inflation declines. Stocks are already down. They're going to struggle, and we're going to get a recession, because the Fed does this every time. Every time the Fed hikes rates, you get a recession. Hikes, recession, hikes, recession. But also look at what happens. The Fed goes too far. They hike rates. We get a recession. But then look at what the Fed does. Rates come way down during the recession. Hike, 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 recession. Fed's got to backtrack. Hikes, recession, Fed rates come way down every single time. And here's the last time. Now we're going to pump rates up to about 2.5%, 3% here. We're going to get that recession. And then the Fed will do what it always does. During these periods, rates come down. And when you take a look, that'll invert the yield curve. Every time the yield curve gets inverted, you get a recession every single time. So the yield curve just got inverted, you're going to get a recession. And the unemployment rate's another big one. When you see the job market and the unemployment rate reach its lowest level and then start to tick higher, just like it did for the last 100 years, in every single case, you get a recession every single time. And here's where we are now. So are we going to get a recession? Well, take a look at this. When inflation for a quarter is above 5%, there's a 45% chance of an inflation historically in the United States within the next year. That happened in the second quarter of 2021, which says there's a 45% chance we get a recession by June. If the unemployment rate is below 4% for a quarter, there's a 42% chance of getting a recession within a year. And that happened as of March of 2022. So just a couple of months ago, we got that trigger. So that says by March of 2023, we should have a recession. But check this out. When they both happen at the same time, there's a 100% chance of that happening. And we just got that. So this tells us that we've got pretty much a 100% chance, at least on a historical basis, of seeing a recession in the next 10 months. So it's around the corner. And during recessions, what happens to mortgage rates? They drop. They dropped 1% last time, almost a 1.125% here. They dropped almost 1% here. They dropped 2.25% here, 5% here, 4.25% here. So mortgage rates drop during recessions. We're going to get a recession and mortgage rates are going to drop, and the housing market should do well. As you can see here, home values during recessions hang in there well and go up. And only one exception was this one. The last one was great. But during the housing bubble, this actually led us into the recession. These were crazy loans. You had people having many homes, they weren't living there, zero down, no income, no asset, 580 FICO score, no job. It was crazy. Fog up a mirror, you got a mortgage. But we know what it's like today, certainly. Now, inventory levels are also different now because you can see inventory is down, 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 down every year. During the bubble, you had 3.81 million units for sale. Today, it's 950,000 units for sale. In order to have a bubble, you need something to sell. We don't have the inventory, so you can't really compare. You see so many people talking about a housing bubble. You don't have the inventory. And on top of that, there's a lot more households. There's 14 million more households and 3 million fewer homes. Look, when I spoke to you in August, everybody was already talking about the housing market being weak. And I showed you all the headlines. Well, and what happened? I told you home prices are going to go up. And what did they do? They've gone up dramatically since then. Home values will still go up, but at a slower pace. And a lot of people talking about affordability. If you did somebody's mortgage last year at 400,000 at 3.5%, this was their payment. To qualify, you had 2 income earners at 4,500 apiece. This year, home values have gone up 18%. So since I spoke to you, if you were to do the same home, you'd have to take a higher mortgage, right, at 472. The rate is much higher too. So that means their payment's up $884 a month. And that's what the media is talking about. Everybody's going crazy over this, but here's what they forget. In the private sector, those incomes have gone up on an annualized basis, 10.5%. So the family's making $945 a month more, which offsets this to a great degree. Now, people are also going to say, well, what about other costs that have gone up? Well, what are your necessities? Food and gasoline. Per household, the statistics show they've gone up $79 and $71 a month. So all in, it's more expensive by about $1,034 a month. So it's more expensive, a lot, sure, but your income's gone up quite a bit too. So the difference isn't as dramatic as the media wants you to believe. So is it more expensive? Should home values slow their rate of appreciation? Yes and yes. But we're not going to see this bubble because we don't have the inventory. Our forecast is that rents are going to continue to go up too. They got up 17% last year on new rents, 13% average on blended rents between new and renewal, but they're going to go up much more than 5%. And that's every year. With a home, once you make that payment, you get that fixed rate loan, it's done. Now, we see mid to high single digit appreciation. That's a lot. If you buy a home for $500,000, you make between $25,000 and $50,000 in profit. You don't want to miss that opportunity. And there's things that you should be doing. Like, for example, you have access to an AVM, which will not only help you, but if you want to endear yourself to a listing agent, you say, I got to do some more purchases. How do I get in good with listing agents? Well, here's what you do. It's pretty simple. What you want to do is call a listing agent, say, I know when you go on a listing, you have to pull a bunch of comps and take a lot of time and present that. It'll take me 3 seconds. I'll be happy to do it for you and give you an amazing report that will show you what the value is so you can bring those people down to earth. But you know what I'll also do? I'll do all the work for you. I'll give you all the comps so you don't have to do it and show you where they are. And then I'll show you what the expectation for how many sales there are, the price per square foot, the median price in the market. So when you go there, you're able to have all this work done for them. And now I know when realtors go on listings, it doesn't necessarily always lead to a direct referral, but that's how you get in your foot in the door with those realtors. But there's other issues too. I want Diana to kind of walk you through those. But before we do you have any questions for me in the interim team? Just put it in the chat box. All right, Di, you can take it over from here.
Sounds good to me. Thanks, Barry.
All right.
All right, team. So we're going to look at the same slides here. And the next tool we're going to look at is the bid over asking price tool. Another really, really powerful one that you should be using, especially in today's market. Yes, bidding wars have gone down a little bit, but not enough. And it's really painful for our clients. So what we'll do here is show them on a specific example here. Let's just say this customer is looking at a $401,000 home. The current asking price is at $399,000, so almost right in line, but they have to come in $20,000 to win this home. And that's kind of on the lower end even. I mean, we're seeing $40,000, $50,000, $60,000 over asking price in some cases, and it causes customers a lot of pain, a lot of frustration, as well as your realtors. It's hard for them to sell that home. So if that customer has to come in $20,000 over, brings their total bid to $419,000, really the only question we need to answer is how long is it going to take to recover that? Well, after one click on our site, you'll be able to see that it'll take only 6 months to recover that. Now, remember that $20,000 over asking price, that's only a 4.98% of the bid over the value. So it really, we're going to make that back in the first year or just in this first part of the second year, really, because over the next 5 years, we're averaging about 4.75% appreciation per year. But really, to drive that point home to our clients, we want to show them what that means in dollars. So after another click here, we're going to see that after the next 5 years, they're going to gain $104,000 in appreciation. I mean, that's powerful compared to what they had to bid over asking price. I think it's a no-brainer that if they're in there for more than 6 months in that home, they should come in above asking price and take advantage of this investment. And you'll see that we put our average appreciation rate, like I said, for the next 5 years, but we want to match it up to what we saw in the past. So we're going to see over the last 62 years, we've averaged about 4.3%. So it's pretty much right in line. It's still conservative, but very, very strong going forward. And then at the bottom, you'll see the same information graphically. It is MLS integrated, so you'll be able to pull in all the photos of the home and all this information on the left side, except for the bid over the ask. So we pull everything in for you. And we know it's tough, especially with rates at very high levels like we're seeing right now. I mean, I always laugh when Barry shows the chart that shows how mortgage rates perform during recession, the one that he showed earlier. I mean, if we think these rates are high, I wonder how a 14% rate felt in the past. But even though about 5.5% is high right now, we know refinance business might be struggling a little bit. But a great tactic to help you with that is hosting an annual review with your customer, utilizing debt consolidation to really help alleviate their fears and their problems. So let's take a look at an example here. Let's just say the rate that you're offering today on a 30-year fix is 5.5%, but your borrower has a current rate of 3.5%. Now, this individual purchased their home 27 years ago. They have 3 years ago, they have 27 years remaining on their loan term. And they purchased this home for $500,000 and they put 20% down. So they had a $400,000 loan amount. Now, in that 3 years, they've made payments on that loan. That home is appreciated to about $720,000 and they paid down that loan balance to $374,000. So a really nice chunk of equity has been built there. Then we're going to add in $4,000 in closing costs. So right off the bat, it doesn't look too attractive. You're bringing this customer up 2% in rate, you're giving them $4,000 in closing costs, and you're bringing them to a new 30-year term. Now, something that most, if not all individuals in the US have is debt. And we're going to ask them, what kind of debts do you have? And I think this is a pretty standard debt picture for any US family. A couple credit cards, Macy's, a Chevy loan. You have alimony here, but the system's smart enough to know that you cannot pay that off, unfortunately. So that's just going to be included in it. And when we take a look at it at first glance, like I said, because of that higher rate, we're going to see that it's going to cost them $300 a month to do this refinance. I mean, they're not going to want to do this. It wouldn't make sense to do this. But remember, look at how much equity you have in that home from your current LTV to your LTV limit at 75%. You have about $114,000 of equity that you can tap into for this customer. So let's do so and pay off these debts. You can click on each row one by one or select them all. And once we do select them all, you're saving that customer $1,500 a month. Now you can stop it there. If you called this customer out of the blue and said, hey, I know rates are a little bit high today. I did your loan in the past. I wish that you can give me maybe 5 minutes of your time. That customer knows you, likes you, they trust you, they'll give you the time. Do this scenario for them, show them the savings, and you can call it a day there. Or, like we always like to do, take it a step even further. Now, one step you can take is, look, you still have about $53,000 in equity that you can tap into. If that customer needs to take cash out for whatever reason, you can do that too. But what if we did this refinance, talked to this customer, and pretended like nothing changed? If we could afford the same payment that they're making now, why not take that and put it right back towards their principal? By doing so, no longer do they have a remaining 27-year term. You've cut that down to 12 years and 8 months. That's nearly half the time. Expressed differently, you're going to see instead of 309 remaining payments, they're only going to have to make 152, cutting that right in half. And immediately you start making these payments. So you're going to see the benefits right away. After just 5 years, rather than amortizing about $48,000, you're going to amortize about $88,000. After 10 years, $210,000. And after that 12-year and 8-month term is complete, you've increased their net worth by $291,000. This is a real game changer for your customers, and every single one of you should be using this tool. And thanks for the nice, kind words, Jeff. This is another tool on MBS Highway. It's called our loan comparison tool. This is going to be for a purchase client that we're looking at because we have to get our purchase business up, but you also have a refinance comparison tool that's really, really intuitive and robust. But what we're looking at here is an adjustable scenario. We're going to look at a fixed with 20% down, no points, and a 5-year arm with a 4.5% rate, 20% down, and no points. And listen, we know it's hard to get an adjustable rate right now in many cases, but that's the point of showing this, because even if you get a little bit higher of an adjustable rate and you see that we're using the worst case scenario here with 5, 2, and 5% caps on this adjustable, you're going to see that even at your worst case scenario, this is still a good idea if the customer is in there for 6.75 years. It's very specific here. Anywhere after that end of that 6th year, they probably should go with that 30-year with 20% down, no points. Now let's take it a step further. Let's change our caps to 2, 2, and 6%. Now it becomes even better for 7.75 years rather than 6.75. But overall, remember that we're using the SOFR index here because that's pretty much what most use for adjustable rates. And the SOFR index is based on the Fed funds rate. And as Barry mentioned earlier, they're looking to bring that Fed funds rate up to about 3.25% by the end of the year. And that's going to affect this greatly. So even at the worst case scenario, with the current being 0.25%, we're going to go up to, let's just say 3%. This adjustable is still a good idea for 11 years. And your customer might say, well, I'm not going to be in that home for the next 5 years. I want to maybe stay in there for 12 years, 15 years. Well, Mr. or Mrs. Customer, this is a great idea for you to maybe take an adjustable. And one other really great opportunity you have here is if you can get a pretty attractive adjustable rate right now. As Barry mentioned, we're expecting recession in the next 12 months or so. Once rates do come down during recession, as they have historically, it's a phenomenal idea to refinance clients out of that and then use the debt consolidation too in the meantime. Now we're going to use the same tool here, but in this case, we're going to take a look at a bit of a different scenario. In this case, we have all fixed rate mortgages. You have one with no points and monthly MI, 1.5 points and monthly MI, no points in upfront MI, and 1.5 points in upfront MI. So 2 monthly MI options, 2 upfront MI options. So if that customer is in that home for less than about 2 years, they should go with that 30-year, no points, monthly MI. Anywhere between 2 and 4 years, that 1.5 point and monthly MI option looks good. And then anywhere after 4 years, that 1.5 point upfront MI option looks good to them. But now if we click and remove some of these options, let's just take a look at the 2 options with points. Let's just say that they know they're going to be in there for maybe 10 years or so. They want to pay the points, but they just don't know if they should do monthly MI or upfront MI. Well, when the client asks you which mortgage insurance should I go with, the answer is very easy to give. Looking at the chart, Mr. and Mrs. Client, if you stay in there for less than 4 years, monthly MI. More than 4 years, upfront MI. And you really help that client greatly make their decision. And then kind of an extension off of the loan comparison, we have our cost of waiting analysis. This is another tool within MBS Highway that you'll have access to. And this is what's going to show you if that customer does decide to go with, let's just say, this 30-year, 4.5%, no points monthly MI option, but they want to wait 6 months or wait a year, wait 2 years. Well, even if you want to wait to maybe get your credit score higher, get a lower rate once they come down, save up more for a down payment, wait for more inventory, whatever reason they're waiting, unfortunately, the market is simply not going to wait with them. We've seen proof of that really with how the market's been performing, and we're expecting that going forward. So in the next 6 months, we're looking here in Monmouth County, New Jersey, where I am, but you can customize this for any area or city or county in the US. But you're going to see that this $400,000 home today would appreciate by about $17,000 in just the next 6 months. And if we assume that the customer keeps the same LTV, their loan amount increases and their down payment amount increases. But their interest rate, let's just say they have a 5% rate today. Let's say they go up by a quarter in the next 6 months, which isn't too hard to believe here. It's really going to cost them about $147 on their monthly payment. Annually, that adds up to about $1,800 here. But it's not only that, because remember, that home's going to appreciate. So over the next 6 months, they would have had the chance to gain $17,000 in appreciation and $2,600 in amortization, totaling a loss of about $20,000 here on top of their monthly payment going up. I think if you show this to your client, they might think twice about waiting and take advantage of the opportunity they have at them. And not only that, your realtor partners will love this as well, just like all the other tools. And you can see here, we beautifully co-branded. So you have your information on the left, your co-brand partner on the right. And if you do not co-brand, it'll just be the Barrett logo on the right side. Now, something else here, the real estate report card. This is something you should be sharing with every single purchase client that you work with and every single referral partner you work with. I've customized this for this zip code in Maricopa County in Arizona. Again, you can enter a zip code, MLS number, address, state and county, and we'll generate this one-page report for you. This is something so powerful because when you think about it, the buying process, when a customer looks to purchase a home, starts very visually. You're going to see that they go to the home, they take a look around, and then they start getting attached. They see themselves living there. But that's not what makes the decision. Ultimately, it's a financial one. And not only this tool, but all the rest of them are exactly what that's helping you with. We're helping sell to that customer as a financial decision. So we're going to see that the current home price, that custom home price, is $310,000 compared to our median home price of $400,000. And the most crucial piece of information here is going to be the appreciation. We've seen very strong appreciation in the past, even stronger going forward, about 9.4% in the next year alone, about 26% in the next 5 years. So if that customer is looking to purchase a $310,000 home, they could expect to gain about $82,000 in appreciation. I mean, what a phenomenal selling point that is. And then since it's a little small, we won't go through too much detail right now. Once you guys start using the tool, we can do an actual training of how to read each and every piece on this page. But for now, we'll just show you inventory, demographics, the renter population in the area, and what percentage of that population can afford to purchase, and then builder numbers on the right side. And this is a really crucial piece because you think about it like this: out of your 27 to 35 age range individuals, those are your first time home buyers. And out of that population, about 58, let's just call it 60,000 of those individuals are going to either rent or purchase a home annually. Well, since we have a high home ownership rate here, about 34,000 of them will purchase a home. So technically, we need to have at least 34,000 homes in inventory in this county annually to meet our demand. We're only building 2,400 here. I mean, this is a big disparity. We're seeing that builders are struggling to keep up, supply chain issues, they can't find workers. And even when they do, it's costing them a lot to hold on to those workers. And we don't know when those issues will slow down, praying that they do. But even if they don't, which we're not really expecting too much alleviation there, this issue should continue. And that's exactly what's so supportive of high home prices in this area, just like all the others that we're seeing. And in the bottom row, just briefly, I'll tell you, we look at employment, the unemployment rate compared to the national average, our median household income, and affordability levels, which have been declining, but are still extremely strong over the 100 level. And again, you can co-brand this with your referral partner. And lastly, just wanted to show you one more tool, Social Studio. So this is a great piece on our website that you can look at in our library, and you'll see that we post different scripts for you. Now, it's hard to make social media content, any video content, hell, even written content. It's tough to make it. We take care of all that work for you. So what we do is we turn your computer screen into a teleprompter, and you can scroll through the script. And as long as you can read, you can create a beautiful, engaging video for your clients and referral partners. And the best thing about this is, as I'm sure many of your friends on Facebook that you're not too close with, they might not even know you're in the mortgage industry if they just added you. What a great way to stay top of mind with them, showing your expertise. So again, your screen would look something like this. You'd see yourself where I am here. And then we'll give you a library of dozens and dozens of scripts on all different market topics. You can even write a custom script. And just to show you an example, here's what one looks like right here. The real estate market has been very strong, and because inventory levels are low, it may be more challenging to find a home to purchase. And then we'll get into some of the meat of the content. Again, we write everything for you, but you're more than welcome to edit this yourself and do whatever you'd like with it. Now, team, that wraps up all the different tools on MBS Highway that you can upgrade to. As your company has already let you know, you have to opt in to upgrade to these tools. So the bid over asking price tool, loan comparison, cost of waiting analysis, the MBS estimate, Social Studio that we just looked at, and honestly, a ton of other tools that we didn't even look at today. To upgrade, it's only $29.95 a month. So if you send TJ on our team, his email is timothy@mbshighway.com. He is manning his email right now, ready for you to come his way. So if you have interest in it, or if you have any other questions, just email timothy@mbshighway.com. and we'll be sure to upgrade you to the higher package with all these great tools. And then of course, once you guys get all signed up, we'll do a full training where we'll go a little bit slower. We'll actually show you on the live site how to create the pieces, how to share them, and how to most importantly explain them to your customers. So I'll leave this up for just a second. If you guys have any questions, you're more than welcome to ask them now in the chat or the questions box. And just so you have my email here, I'm going to put my email, diana@mbshighway.com. Again, Timothy is the best person to email to upgrade your account, but you're more than welcome to email me too with any other questions too. And if everybody's okay for now, if you're going to head out, I just want to say thank you so much for your time today. But if you have any questions, I'm here to answer them. Yes, Antonio, that would be the highest membership level. Yes. All right. Any other questions here before we sign off? Make sure you have this email taken down. Yeah, Alexandra, I will for sure. It might be Sasha or myself will send it. Linda, if you want to just email us at support@mbshighway.com or call us, I'm going to put both the email and the phone number right now in the chat box. You can give us a call whenever. So you have both pieces of information there. And we'll walk you through the debt consolidation tool. Any other annual or monthly costs? No, not at all. With MBS Highway, it's just your straight monthly cost. This would be the only additional cost to upgrade. Sorry, Antonio, do you mean is like CMA included in this, or does it have any kind of relevance to CMA? I'm sorry. Yeah, so I think a ton of relevance actually. So, you guys know MBS Highway pretty well now. You have our daily morning updates, our lock alerts, all our different market updates, and all the different great tools that we just looked at now and many others. But CMA was really built off of what we built in MBS Highway and what's in Barry's big brain of his. So we've taken all the knowledge from the last 30, 40 years in the industry and package it into the one course. So the really great thing about CMA is not only will you have access to the MBS Highway tools that coincide with the CMA modules, but you'll be able to use the teachings that you've learned in CMA every single time you use the MBS Highway tools. So when you show the loan comparison tool, for example, you'll be able to know, okay, when I'm calculating break even of closing costs, right? Let's just say we have $4,000 in closing costs and you save a little bit a month on your monthly payment. Well, really, we're taking into account the interest portion of our savings rather than the entire monthly savings, something that isn't really taught correctly. We've broken that down for you in the CMA course the right way. So when you're using the loan comparison tool, then you can use what you've learned in CMA to really express that point to your customers. That's just a very simple example, but there are so many others. I think too, one of the most impactful parts of CMA is watching the technical analysis. So we'll show you candlestick charts, how to read them, how to notate them, and show what different patterns mean to your clients. So I think that's a really important part too, because yes, MBS Highway, it's our main job to watch the markets for you, but not only can it help you with your clients, it can also help you in your personal investing. I've been a pretty much a crypto advocate now because I know candlestick charting and can actually watch it. Just reach out to me, Antonio. I'll put my email again in the chat box, diana@mbshighway.com. And if it's not me, I'll get you over to the right person. All right, guys, does anybody need that email again? If so, it's timothy@mbshighway.com to upgrade. My email is diana@mbshighway.com. Oh, that's right, Alexandra. Yeah, you guys have a trial basically of the upgraded accounts until end of month. So get in there and test them out. Yeah, thanks for reminding me. All right, team. So I still have some time if you all have questions. If not, I just want to say thank you very much again. And from Barry as well, thank you so much. And if you have any questions later on, just give us a call, send us an email, and we'll talk to you soon. And thank you, Alexandra, for having us on. All right, everybody. Thank you so much. Yes, I'm going to send the recording to Alexandra, Jerry, and then I'd assume she's going to get it out to you. All right, guys, thank you very much, and we'll talk to you soon. Have a great one. Yeah, Jerry, we're aware, unfortunately, not that it's a laughing matter at all, but if you want, you should go to our Facebook group. I actually really highly suggest it. I've been posting little market updates in there every few hours. So I just put the link in there to our Facebook group. I'll accept you right away if you request. We posted the morning update in there, the market wrap I'll be posting soon, and then periodic market updates and any other general information you need. So please, great. Okay, cool. I see it come in. So I'll accept you right away. All right, guys, have a great one. Talk to you next time. Bye-bye.